you can still work your active W-2 job or business and still qualify for short-term rental tax loophole.
You can have another job or business while taking advantage of the short-term rental tax loophole. You cannot do that with real estate professional status if you're doing it properly. If both spouses are working, this is the only real way you can buy real estate and save taxes. Welcome back to STR Like the Best. I'm your host, Michael Chang, here with my wife, Elizabeth.
Hello.
And we're going to talk about a topic where we got really bad advice from our CPA back in 2018.
A different CPA from that.
Different CPA. Not our current one. If you're listening, we love you. What was the wrong advice?
Yes, I think it was 2018. We had a different CPA at the time. And I think that was right after I left my job at Case Bay.
Yep.
So we started looking into real estate investing, specifically in short-term rental. And the first advice he gave me was, you should get a real estate license so you can get the tax benefit without much more context. And little did I know, I went to get my license. That doesn't really work.
It doesn't work. This is something that you're listening, especially if you're married, you don't want to give your wife or husband unnecessary homework.
Yes.
So there's this thing called real estate professional status. And I've covered this in a different episode, the difference between real estate professional status, which is reps, and the STR tax loophole. Two very, very different things. And they're kind of mutually exclusive. A lot of people have this misconception that you have to get your real estate license in order to get real estate professional status or take advantage of the benefits from owning and investing in real estate. Is that true, Liz?
You don't need it. You really don't.
You don't need it. If you have it, it doesn't mean that you are a real estate agent. Just because you have a license means you're a real estate agent, but it doesn't mean you're a real estate professional based on tax code. To be a real estate professional, there are a number of things, but two key things. One is you must spend a majority of your time on the real estate business. So if you have a job, a W-2 job, you are highly unlikely to do more in your real estate business than in your regular job. You're working 40 hours a week, you got to work 41 hours a week consistently to hit that. Not going to happen. One of the most heavily audited parts of tax code. Second rule is that it has to be a minimum of 750 hours. Very defined activities. Not being an investor, actually being a real estate professional. Unless you are a full-time professional, you're not going to hit that. Just getting your real estate license doesn't mean you're going to hit that. We thought that 2018. And we're like, I was like, hey, Liz, you should go get your real estate license we can do this.
Yeah. And I went on and get my license and realized it doesn't automatically qualify me for the tax benefit for our family. So what we end up is we discover short-term rental tax loophole. And that's a really big difference between how you can qualify for it and why you don't need to be a real estate professional in order to do that.
Exactly. So 2018 was during the first Trump administration when they passed the TJCA Act, which is 2018. And that was the first time 100% bonus depreciation was introduced or brought back. The material participation construct, that was already there. So for the STR tax loophole, it really is combining that 100% bonus depreciation with the material participation. And the only way you can really do that is with short-term rentals for real estate. And that's why this works. So why is the STR tax loophole better than reps for almost any working professional?
I think a couple things. First is you can still work your active W-2 job or business. If you own a business, you can still have that and still qualify for short-term rental tax loophole.
I'm going to pause you there. You can have another job or business while taking advantage of the short-term rental tax loophole. You cannot do that with real estate professional status if you're doing it properly. If both spouses are working, both partners are working, this is the only real way you can buy real estate and save taxes.
Frankly, it's a better way because material participation, you only need to do 100 hours and then more than anyone else. And that's very achievable with short-term rental investing. We have proven it multiple times with our clients, ourselves. So this is a very viable strategy. Even both of you are working. Even if it's one spouse is working, the other one is a stay-at-home parent, that's also a very powerful strategy.
But let's focus on both spouses working, because I think that's a lot more of, I think for most people, both spouses are working, right? Cost of living is really high. If you live in a high-cost location like New York, San Francisco, LA, Dallas, both spouses are working. I think for most of our clients, both spouses are working. I would say 80% of them, they're both working. This is the only way that, one, you can do that. One, you can take depreciation of properties that you own and offset against your W-2 income.
Correct.
So if you're both working, the one takeaway from this is you don't qualify for reps. 99.99% chance you don't qualify for reps. Getting your real estate license doesn't change that. And you should challenge your CPA if they're telling you that, because they're wrong. The second thing is it's very doable. Even now, we're almost in August. Is it doable now? You're like, that's 100 hours to do. We're both working. You have kids, kids are going back to school. Is this even possible?
Right now, I would say it's still possible. You will need to start looking now, find something. In average, I think within our client, they can find something around 30 to 45 days. They can go on the contract, and it takes about a month to close. Another 1.5 to 2 months to launch, depends on how turnkey the property is. So it's possible you can still do something by this year.
I would argue, in a way, it's easier to do it around this time. Now, obviously, time is more limited, right? It's August. I'm going to just say it's August right now. You have 5 months. Buying a property with a mortgage and everything takes about a month, 2 months, right? And you have to meet that 100-hour requirement. There's 7 different ways to meet material participation. One of the most common ways is a minimum of 100 hours combined if you're married. No one else does more than you. Now, it's that no one else does more than you that's kind of gotcha sometimes, right? If you start too early in the year, you got to really manage that cleaner to make sure that they don't exceed yours. With starting a little bit later, yes, it's a little more time pressure. But once you close and start recording your hours, there's always kind of setup time that you and your spouse are going to do. So, plan your vacation and plan your work accordingly. If you can remote, obviously better. If you can do it together, better. If you have some family support that can watch the kids for a little bit, or if they're older, they can self-serve a little bit, you and your spouse can go down there and knock it out. Just think about it, right? 5 days, 10 hours each. It's a long day, right? But 10 hours is nothing in the world. 2 people, 10 hours times 5, 2 times 10 times 5. It's 100, right? And that's, you knock it all out in that 1 week period. And you get to do something together. Your job to manage someone else not doing more than you becomes a little easier just given the amount of time. Right?
Yeah. And also just from experience, you need way more than 100 hours. Yeah, not to scare anyone, but it's there are other things you need to do.
Not way more. Let's, but not, I think, there's a degree to that too. Depends on the type of project you're looking for too.
A type of project.
We have clients that are buying 2-bedroom condos. It's not it's a very different project than an 8-bedroom, 6,000 square foot cabin that we just bought.
That's true. But I would say just there are also desktop work that you can do at home. And those will take up quite a bit of hours. A lot of people had the misconception it need to be you are the person cleaning the property.
No, yeah, thank you. Yeah.
That's different. You can do other tasks to fulfill those hours. You don't need to be the person doing the cleaning, doing all the turn, physically being inside the property.
Exactly. So you don't physically have to be there, but I want to just make a few things clear here, right? So the IRS doesn't audit the strategy. The IRS audits the documentation. So make sure that you're clearly documenting everything that you're doing day of that you're doing it, right? So they want you to kind of construct this record real time. There are apps that you can download. You can use a pen and paper. You can use a spreadsheet. Whatever is going to allow you to do it consistently, the easiest, that's the method that you should do. There's an app that we developed. It's called the STR Tax Loophole. If you go www.thestrtaxloophole.com, you'll find it. We made it just for short-term rental investors. Number 1, make sure you're documenting hours. 2 is what hours don't count. Investor hours don't count. Hours that you do as an investor, your education, listening to this podcast, going on YouTube, going on Zillow, those don't count for this purpose. For material participation, those don't count. It only counts once you are in contract, right? Past your diligence phase. You're working on setting up your short-term rental, right? You're building your team. You're doing all the things that you're doing for the short-term rental. And then after you close the property, if you're down there working on the property, if you are working at it from home, the stuff that you're working on that's directly related to the operation of that short-term rental, those hours count. Not, hey, I spent an hour on YouTube watching how to, put together a short-term rental. That doesn't count. So I just want to make sure, but we want to clear up some of these misconceptions so that you do it the right way. I think 1, doing it for 10 years. I think 2, also we have young kids and this is our livelihood. We take a purposely conservative approach to most things here because we don't want to screw it up for ourselves and we definitely want to screw it up for our clients.
Yeah, 100%.
So which brings us back to the point in 2018 when we got the wrong advice from our CPA. You know, like not their fault. We had a misconception of what a CPA does. What was our misconception?
I think the misconception at that time is like our CPAs, they should be the one driving this strategy for us, telling us what we should be doing in order to maximize our tax saving, for example, or how should we think about wealth building. But not really. That's not what they are there for.
Your CPA is not your tax strategist. Why didn't my CPA tell me this? Or why doesn't my CPA understand this? Now, there are a lot of great CPAs out there, right? So this is not a, you know, we're not dissing CPAs or anything. It's a common misconception of people what the purpose of your CPA is. Your CPA's purpose is to file your taxes for you and file it in a way that is conservative, most generally speaking, conservative, right? Their job is to make sure that you file properly and accurately. Everything that you're telling them is documented because they have the obligation to do that under the IRS rules. Their job is not to save you taxes. Their job is not to minimize your tax burden. Their job is not to think about it for you. Their job is to file the documents that you give them properly, right? If you have deductions, to make sure that they've done their work on that. You know, the tax code is complex. And if your CPA is, you know, they're generally just doing taxes for W-2, right? Workers. So it's fairly straightforward. You have everything on your W-2. You own your personal home. You have some stocks. You might have a long-term rental. It's pretty straightforward. So it's like, you know, that's for most CPAs, that's kind of the standard client. You come in with SCR tax loophole, like bonus depreciation, material participation, grouping elections, these complexities, like not every CPA knows, right? Like you don't go to, if you need brain surgery, you don't go to a podiatrist. You need to find the expert, right? And they're not easy to find. The current person we work with, you know, we've been working with him for the past 7 years. He's great. Yeah. He's a real thought partner to us. But, you know, I think that's the part where people are like, well, shouldn't my CPA know reps and give me the right advice? Maybe, maybe not, but that's not ultimately their job. It's ultimately your job and your responsibility.
Yeah. And I think what changed course for us was after we left the CPA, we were looking for a new CPA at the time. We already heard about the short-term rental tax loophole, and we had the pieces, but we don't know how to put them together. And then we found our current CPA and mentioned it, and he really specialized in small business and real estate. And having that thought partner with you, talking out what we were thinking, kind of like solidified
it.
The strategy for us together.
Because I had the pieces. I was doing the research. I had the pieces, but I didn't know how to put it together, and I didn't know if I was right or not. And this is before there was the ChatGPT and Claude. I didn't have, so I had to kind of piece it together. But I needed someone that actually really understood the tax code and helped me kind of piece it all together. So I mean, a little bit of advantage that we had in the beginning because we figured it out. In 2020, we figured it out a lot earlier than other people.
Yeah.
I think one, we were, you know, Airbnb was what we were doing. And then two is we had a CPA that was our thought partner versus someone that was just filing our taxes for us. And that was a real game changer for us. And that's why,
it was a game changer.
Really, really enjoy working with him. And so I think fundamentally that responsibility comes down to you, right? And if you're listening, you're doing that now is, you know, developing those ideas, stress testing them, use ChatGPT or Claude and stress test those ideas and go to your professional and have a point of view that's documented and be like, hey, this is what I'm thinking. Does it apply in my situation, right? Because your CPA, your tax professional, what they're going to be really, really good at is they understand, like, you might have that specific strategy that you've thought out, but there's other things that you might not have thought about in your broader situation. So they can kind of connect the context of everything that you have within your tax situation with a specific strategy. So that's a really good way of working with your tax professional. And just because that's what we've done. And I think it will eliminate a lot of these mistakes that they might make or you might make. It'll help you create wealth a lot faster. If you can figure out your tax side, being more efficient on the tax side. Remember, taxes are it's for everyone. It's their largest expense. People don't realize that.
They don't realize
because
that.
It's taken
I didn't
out.
Realize till you told me that, and then I was like, "Wow, you're right."
I mean, we live in New York City. It's over 50%.
Yeah.
You look at your $800,000 income. You're like, oh, we're doing really, really well. You know, you don't make $800,000. You make $400,000 if you live in New York City. Probably a little less than that. It's still really good money, right? But it's not, 400 versus 800 gross pre-tax. Government gets half. You take the other half, and you have to deal with high rents or mortgage payments and kids' tuition and everything that's been inflated so much. So a really, easy way, but a more straightforward way is you know what? Keep more of what you earn. I want to make
Yes.
more, right? But also, there's some low hanging fruit there that I think a lot of people can, if they're, they do a little bit of work up front, like you're doing right now, if you're listening, to keep more of your hard earned money, especially like if you're, spending time away from your kids and your family, like make that count, right? I mean, if your gross is 100, try to get as close as 100 for your take home as you can.
Yep.
Like, just makes sense.
Yep. And that's why we do it.
Penny saved is the penny earned.
Yep. Keep more of what you earn.
So if you like this episode, and I definitely would recommend, having a conversation with your CPA, just like talk about, hey, I'm thinking about doing, either STR tax loophole or a different strategy. A lot of our clients go to their CPA first, ask them about it, validate it with them, see if it fits in their situation. I highly recommend just doing that and just making sure that it works for your situation. And if it does, then you can do a little bit more research on, if this is the right fit for you. And that's part of that equation. And then, having that straightforward conversation, a little bit, research on your side with your tax professional can really kind of move the ball forward for you. Because you do want them to make sure, we're not CPAs. We don't represent to be. So you want to make sure for your situation, this is a good fit for you.
And what are some of the questions people can ask to see if their CPA actually understand this?
There's one really easy, I guess there's two questions. I think one really simple question is, do you have other clients that use the STR tax loophole, right? So like, do they have experience doing this? Yes or no, right? That's a really easy one. And then if they say no, but like, hey, we understand this, my litmus test for them, it's a really easy one is, okay, so with short-term rental income, is it Schedule C or Schedule E? And if they don't really understand this strategy, they're going to say Schedule C. And you're going to pay more in taxes because Schedule C income is self-employment taxed. You don't have to pay self-employment tax on Airbnb short-term rental income. It's filed in your Schedule E. It's still passive from a income tax perspective. So you're not paying the 15.2% self-employment tax. So that is a test. That's a really easy test, or a really easy question to ask your tax professional. If they say E, then they, did a little bit of work on here. If they say C, then, you have to decide if, you think that person can be, if that person is the right fit for you, if you decide to use this strategy. So
thanks for sharing. Yeah. I think that's a really good limited test.
This is an easy one,
Easy one to really understand whether or not the CPA is a good fit if you want to execute this strategy for you. Thank you. If you like this episode, please give us a follow and leave a comment, tell us what you'd like to hear about next. We'll see you on the next one.
See you next episode.